What's up, guys? Welcome back to Investing PH. My dividend portfolio just keeps on growing every month. It has now reached another all-time high of 4.42 million pesos from my invested capital of 3,167,500. That gives me a total return of 39.45% or 1.2 million. This translates to an annualized return of 11.8% ever since I started investing. Out of that, 568,000 came purely from dividends. Just last July, I received 19,661 pesos in dividend income. That puts my latest 12-month monthly dividend income at 16,685 pesos. Now, my goal this year is to hopefully reach a monthly average of 18,000 pesos above. So is it possible? Maybe, because a lot of my stocks like Costco, Pure Gold, and AUB delayed their dividend payments and announced them at a later date. And even with those delays, my average is already 16,685 pesos. Seeing the growth of my dividend income really gives me that fresh momentum boost to keep pushing with this strategy, and the fact that most of the companies in my portfolio are performing well gives me even more confidence, since this means future dividend growth is also very likely. Now, let's talk about portfolio performance. My portfolio has done quite well compared to the index. While my portfolio kept moving upward, the index has actually been trending sideways since the start of the year. In fact, if we zoom out further, this sideways trend has been going on ever since the pandemic, and even as far back as 2014, more than a decade now. So, is index fund investing dead here in the Philippines? Well, that's exactly why I'm not a big fan of investing in index funds locally. The management fees are very high compared to other countries, and on top of that, you don't even earn dividends from them. Hopefully, this improves in the future. But as of now, my preferred strategy in the Philippines is dividend value investing. And here's the thing, the gap in returns between my portfolio and the index just keeps getting wider, mostly because of dividends that I've reinvested over and over again in the past 6 years. The more the market stagnates, the bigger the gap becomes, since my portfolio is consistently earning dividends at an average of 6% yield, and those dividends get compounded again and again. Looking at valuation, my entire portfolio has a payout ratio of only 40%, even with a large portion invested in REITs. Based on discounted cash flow, the fair value of my portfolio is about 10.59 million pesos, meaning it's still 58.2% undervalued. Some quick comparisons: P ratio 6.4 versus the index at 9, price to book 0.6, earnings growth 13.9% versus market at 13.4%, ROE 9.2% versus 9%. ROC is lower, but return on assets has a huge difference, 10.5% versus 4.3% for the market. Now, if you're wondering where all these charts and numbers are coming from, it's from Simply Wall Street. They've got tons of features all in one platform. You can easily analyze a stock to see if it's worth adding to your portfolio. The way they present their data is so easy to understand. They provide insights, comparisons, charts, and even a stock filter where you just input your criteria and it automatically gives you the list of stocks that fit. What I love the most is their portfolio tracker. You can input all your transactions and instantly see the health and performance of your portfolio. The best part? They offer a basic plan that's free forever, but if you want unlimited access to all their tools, sign up using my link below to get up to 50% discount. Thank you, and now back to the video. Quarterly earnings have just been released, and a lot of companies in my portfolio showed strong results. Costco posted a 9.3% increase in net income during the first semester. C-REIT reported a huge 38% surge in net income for the first half. Security Bank grew by 8%, with total revenues climbing 23% in the same period. A-REIT posted a solid 45% growth in net income for the first half, while also declaring higher dividends. LTG's net income jumped 17% year-on-year, driven by a 22% growth from PNB. Their tobacco business rose 12%, and Tanduay surged an impressive 91%. DNL reported a 6% increase in earnings for the first half compared to last year. FGen grew net earnings by 5.2%. FLI showed only a modest 1% growth. Pure Gold increased net earnings by 7.1%. Megaworld jumped 23%, and they recently announced their dividend payment, which has increased once again. Now, I actually delayed releasing this portfolio update because I was waiting for the stock split of AUB. In case you aren't aware, they did a 2:1 stock split. This means your number of shares gets doubled while the stock price is cut in half. But don't get it wrong, this has no effect on the company's financials. Companies usually do this to lower the stock price, making it look cheaper, or in the case of the Philippines, it could be to lower the initial cost of investing their stock since we still follow minimum lot sizes. That's why I often say, why don't Globe and Tel do a stock split? Their minimum lot size is 5 shares, and with their stock price sitting above 1,000, it becomes harder for many investors to buy in since you need to save up a larger amount just to purchase the minimum lot. So anyway, this is why AUB's price plunged by almost 50% recently, but your gains are still the same. That's just the effect of a 2:1 split. There's no change in its financials. This move is more of a psychological adjustment, since lowering the entry cost makes it easier for investors, especially dividend investors, to reinvest their dividends into the stock. Right now, AUB leads my portfolio, making up 9.54% of it, followed by LTG at 8.46%, Globe at 7.07%, MBT at 5.51%, AP at 5.29%. These percentages are based on current market value, which I think is a better way to present my portfolio rather than just showing my invested capital in each, because this reflects the true value of each stock in my holdings. For the stocks I bought recently, I only bought 3: Globe, TEL, and MBT. I've been maximizing investing in bank stocks whenever they drop below my buy price. Since I want to build up that sector more, I also wanted to add to the power sector, but last month, most of my energy stocks didn't fall to my target prices. Hopefully, I'll be able to add to them soon. Every month when I buy, I usually focus on certain sectors to balance out my portfolio. This year, it's mainly been telcos, banks, and power companies. As for REITs, most of them have already gone above my buy below price, so I haven't been adding much there. With real estate, I'd only invest small amounts since I already have a large allocation in that sector. If I do add, it would likely be Shang Properties. Recently, DRAGONFI announced a new buy price for Meralco, and I've been considering whether to copy that move. I've always wanted to add this stock to my portfolio, so I'll be analyzing if now is the right time to buy in. By the way, if you want to follow my investments, you can do so through DRAGONFI. You can support my signature portfolio there, where the buy below prices are always updated. If you're not using DRAGONFI yet, you're definitely missing out. Sign up with my referral code and both of us can get up to 1,500 depending on your initial funding. So for now, my game plan stays the same. Keep investing in undervalued companies in my portfolio, reinvest every dividend I receive, and hopefully reach my goal of 18,000 a month in dividends this year. Here in the Philippines, since our market tends to stagnate for long periods, dividend investing has really been the most effective strategy, and it's so easy to maintain. It's basically just buying undervalued companies every month from your watch list and leave it there. The best part, dividends help you buy even more shares. All the tools I use have made this process so much easier. DRAGONFI provides a great platform, while Simply Wall Street helps me quickly analyze stocks. Both keep me updated on what's happening in my portfolio. Back then, I had to do everything manually. Now, it just takes me minutes. The more I automate and simplify, the more sustainable this strategy becomes long term. After 6 years of investing, here's one big lesson I've learned. You don't need a lot of action to make money in stocks. In fact, it's the opposite. The less I do, the easier it is to tune out the noise and focus on what matters, staying in the game for the long run and letting my money compound. With that said, I hope you've learned something from this video. If you did, make sure to hit the like button before you leave. And if you want to support the channel even more, use my referral code from Simply Wall Street and of course, support my signature portfolio in DRAGONFI. Thank you for watching and I'll see you in the next video.